Hello, everyone. My name is Sheila Harris, and I'm the president of LAI International, and I'm very pleased to welcome you to our first webinar. And I want to thank our friends at Economic and Planning Systems, Inc. for putting this presentation together on COVID-19, cross-cutting trends towards a new reality. This is the first part in a series of 2. We plan to do this within an hour, and I want to thank everybody who's been very, very helpful in putting this together, particularly Kathleen King, Phil Adams, Todd Kabamban, and of course Jim Musbach, who will then introduce the panel in just a couple of minutes. We've got over 120 people on the call today, and from Hawaii to the United Arab Emirates. So we are being definitely LAI International today, and having nearly 20 of our chapters participate in this effort. And several of you who are online who are not affiliated with LAI, we're an international organization of land economic professionals. And if you're interested in joining us, we would love to have you be a part of our group. And without any further ado, I'm going to turn this over to Jim Musbach, who then in turn will introduce the panelists. And I just had a sneak peek of this presentation yesterday, and we're in for some really good information, and we really want to thank our friends at EPS for sharing it with us today. Jim?
Thank you, Sheila. I'm Jim Musbach. I'm a senior principal with Economic and Planning Systems in our Oakland office. And I am a member of the Golden Gate chapter of LAMBF and have been since 1994. I also serve on the board and executive committee at the international level. The COVID-19 pandemic is unprecedented in all of our lives. I think it's safe to say. We've never seen such a fearful pandemic sweeping our country and sweeping the world, and the complete, almost complete shutdown of our economy all at one fell swoop. It's a great time of uncertainty right now. Nobody really knows how this is going to end. There's a lot of pressure, political and social, to open up the economy and open up the country and have people get back to normal. We don't know what the consequences of that may be. And everyone's trying to figure out, I think, what does this mean for all the work that we do, for our society, for our economy, and so on and so forth. We've been fortunate at EPS to actually have several clients who brought us in to do some analysis around this to try to foresee things that are coming out of this. And there's 2 different kinds of things that are going to be temporal or temporary, and things that very likely will be structural and last for a long time. Hard to foresee the future when you're in the belly of the beast, but we have collected a lot of good information we'd like to share with people, along with some insights, and to solicit insights from all of you who are on this call as well. This is going to be done in 2 parts. The first one's going to look broadly at the socioeconomic impacts and implications of the COVID pandemic. And the second one will zero in on specific economies or sectors of the real estate economy in particular, which also obviously has social and other ramifications as well. So I'm going to turn it over to David and Jason, who are the principal researchers on the work that you'll be seeing. And if people have questions as we go through this, if they want to post it on the Q&A at the bottom of the Zoom menu, we'll try to bring some of those in. We're going to take a break midway through this to have a little bit of a conversation, and we'll try to pick up some of the questions that you submitted. And if we don't get to them this time, we'll try to address some of them in the next one. And with that, I will hand it over to my colleagues, starting with David Zender.
Thanks, Jim. And Jason, do you want to briefly just introduce yourself?
Yeah, I'm Jason Moody. I've been with Economic and Planning Systems for, I'm going to say, almost 20 years now. I'm an owner and managing principal, and very excited to be here.
Thanks. And I'm David Zender, also a managing principal with EPS. I've been with the firm since '92. I had the pleasure of working in the then Berkeley office with Jim and Jason coming out of Berkeley in '92. And been with the firm ever since. So it's been a wild ride, and it's continues to be wild as we speak. So we're going to take you through the first in a 2-part series. And today, it's cross-cutting trends toward a new reality, temporal or structural. And this is the question of the day. Are we looking at something that's a blip on the radar, or is this an everlasting sort of permanent adjustment that we all have to reckon with. So the overview of the presentation, we're going to take you through the notion of a theoretical crisis and recovery timeline. Think about sort of how we're responding. Is it an effective response? And then think a little bit about the key questions, sort of temporal versus structural. And then we're going to allude to some of the real estate trends that come from these drivers in the larger macro economy. And we're going to sort of whet your appetite for session number 2 toward the end and give you a little bit of a preview as to how the asset classes are reacting. So, crisis and recovery timeline. So the title of this slide is Public Health versus the Economy, and that actually says a lot right there if you think about it. The slide could be called Public Health and the Economy, or any number of variations on the theme. But this cuts right to the chase in terms of, how are we dealing with the pandemic, and how do we optimize our response to it, if you will. So as we know, human interaction is critical to economics. It's hard to divorce economics from psychology, as most of us in the field know. And so as we think about the response to this, taking the form of social distancing and other public health measures, these effectively really take us away from the places where goods and services are produced. They reduce our confidence in attending large events, and they create a real limitation on spending. But we all know that it starts with a strong, healthy workforce. This economy goes nowhere unless we take care of our own. And that's at the heart of most major economists' read of the current situation is job number 1 is to take care of public health. And from there, we think about sort of how does that ripple through the economy in terms of spending, goods purchasing, and demand, and right around the cycle we go. The notion of a recovery, the shape of the curve, this is just indicative of several ways things could go. But initially we talk about sheltering in place, and then there's a second phase of containment reentry, theoretically a nice transition to recovery and cure. And then we have a new normal, or as Jason likes to say, a new abnormal. But basically we have a situation now where we don't know if we're going to see a linear sequence such as this. There's any number of variations on the theme, and much depends on future human behavior, our public policy response, and how the economy snaps back or doesn't is contingent on many variables. We're going to take you through some of those today. So in terms of what the prognosticators are seeing out there and how we're all sort of responding to this in real time, it's very interesting to sort of think about the pundits and what we're all saying about it. It kind of divides into the bulls and the bears, if you will. And on the bearish side, there's the notion that, well, I don't know if this is bearish, but Thomas Wright and Kurt Campbell at Brookings make a good point that the pandemic has laid bare really the status of our economy. In many ways, we were headed toward a very, very strong economy with low unemployment, a lot of good indicators. However, many in our labor force are very close to the bone in terms of discretionary spending potential already, and just living month to month. And those types of trends are very apparent now as we move into this next phase, and we're dealing with some of the fallout from perhaps not strengthening all elements of our labor force in the recovery that's been rather uneven. Other folks out there see maybe a 2 or 3 year sort of recovery pattern. Jess Staley with Barclays is a little bit down in terms of perhaps there's a notion of not being able to hold on to office space if you're in the professional services industry, and perhaps demand could drop by 50% or more. There's an overall lack of deal volume in this current environment, where sellers are basically holding on to sort of their preconceived notion of asset value. But buyers are looking at the situation and seeing something very different and wondering where the discounts are. And right now we're in sort of this stasis mode where there's just a lack of transactions and a lack of velocity in the market. On the more bullish side, so that's sort of the downside. On the bullish side, there are folks that sort of see this as something that we can snap back from very quickly. And so you see a couple of those comments on the left. the notion that because our economy was strong coming into this, we didn't have a fundamental issue around subprime mortgages or other things of that nature. We are in good position to snap back. But the question really is, and we'll get to the notion of discretionary spending and retail and so forth, if you think about the mom and pops that are out there and the scrape off that is likely to occur, how quickly can some of these businesses build back? So we have the physical edifice in our downtowns and so forth, but do we have the economic vitality that's going to carry us through and avoid a permanent structural change? And so you see there's a notion that we can snap back currently, whether it's the housing market or other elements. There's the leader of the leader of the United States, President Trump, is obviously feels that this is going to be a tremendous surge going forward, and there are good reasons for him to want that to happen and to believe that can happen. And then we have, obviously some prognosticators out there, some of whom are a little bit less clear. Elon Musk saying, take the red pill. We're still trying to figure out exactly what that means. But I can assure you that it's more complicated than that, and we're sort of dealing with all of the fallout and the ins and outs of this. Of course, there's Warren Buffett with timeless advice: be fearful when others are greedy, and greedy when others are fearful. And judging by that advice, we should be a little bit greedy right now. But let's see how the rest of the evidence lays out here.
Good slide.
Yep, have a slow computer. Bear with me for a moment. Okay, so this slide shows 2020 GDP forecasts by quarter. These are annualized evaluations of GDP growth by quarter. You can see in Q1, we were at -5%. So that's an actual data point. And then moving to Q2, you can see the wide range of expectations, all the way from the University of Michigan, sort of at the upper end here, sort of just below 0, and then all the way down to the Goldman Sachs projection, staring at close to -35% GDP. What's interesting is how do we rebound from this? So as we look to Q3, how does that, how do these prognostications compare? So you can see that the more dire Q2 projections translate to more optimistic Q3 projections. You can see Goldman Sachs coming to the top there, expecting really a strong recovery, perhaps in the 20% range in Q3. So overall, when you get toward the end of the cycle, toward the end of the year, the prognostications are not so different from each other, generally hovering around perhaps neutral to no growth to slightly higher growth. However, it's really what happens in the next 2 quarters that's going to be very interesting to follow. So as we think about that, we first look at consumer spending. And as many people know, much of our GDP is tied to consumer spending, about 70%. Within that 70%, 20% is household spending that is discretionary. And that is all really up in the air at this stage. You can see the behavior on the chart in terms of the dramatic drop down from March to April. And now we're sort of on this bumpy recovery with a very slight positive slope. And so does that get us back to where we want to be, or is it going to be a tough road ahead? You can see that the drop in real GDP has been quite dramatic. And you can see that US unemployment claims have exceeded even those which we thought were pretty dire and pretty draconian just 2 or 3 weeks ago. People were prognosticating about 20 million, maybe 25 million. The numbers appear to be headed toward much, much higher levels. And so as we think about unemployment, I think we just have to consider the fact that the Fed is in a place where rates are very low right now. And the run-up to this was indicative of a policy where rates were going to be left low in order to try to get wage growth to begin improving, which bears the risk of some inflation. Right now, we're going to have to see how all this plays out, and we'll come back to federal policy in just a moment. So taking a look at the public health situation in terms of cumulative deaths per million residents, you can see here that there's a number of economies that bear watching. And so some of these would include Boston, Chicago, and a number of others. And you can see in some cases that we have inflection points, excuse me, that are perhaps indicative of the future. We just don't know. The next 2 to 3 weeks are going to be really interesting as we go through the manifestation of some of the easing policy that we've been looking at. All states are on a different course, and so we'll see how all this manifests. Some of the cringe-worthy events that we've seen, for example, in the Ozarks, are interesting because the folks that were congregating in these really highly concentrated crowds are not from these rural areas, but they're going to be flying back to their host communities. And so this is going to be very interesting to see if there is a meaningful response in terms of viral behavior. So in terms of the response, it's a work in progress, obviously. We are printing money like we never have. It's really massive federal stimulus. It's hard to characterize it any other way. And it's going toward a variety of areas, obviously, in terms of reaching out directly to businesses and households, but also education, transit, CDC, and other uses. So the question is sort of, do we need to continue to do this? Have we done enough? And so we're sort of walking this line right now, and time will tell. But it will be interesting to see the implications of issuing this level of debt, which is unprecedented. Certain observers have raised the concern of stagflation that could occur with increasing inflation, mainly if it responds as theory says it would, and in the face of lower productivity due to a number of other factors such as possible deglobalization. So there could be some unintended consequences, and it'll be interesting to watch the process. This is also a public policy related graph. What you see on the right, on the horizontal axis, is basically the New York Times categorization of public health policy, with more stringent social distancing requirements being left in place on the left side, and then the most liberal sort of opening up of economies on the right-hand side. And then you can see the death rate on the vertical axis. And so some of the communities to watch for are in the upper right-hand quadrants. And so as we look at Denver, Atlanta, Miami, and Minneapolis, all of these are above average in terms of death rates, and all are subject to moderate to aggressive social distancing easing. And so will this play out in some predictable way, or is the virus more sort of subtle and unpredictable? And time will tell. Another area of we're very keenly interested in is the governmental response at the local level. So we've seen it from the federal level, the state level, and now thinking about the local level. This is the next wave of impact, really. Many of the local governments haven't felt yet the true implications of the loss of retail sales tax, TOT, and other sort of revenues that are sensitive to to travel and entertainment and some of the key areas of our economy that they were relying on. So as we start to think about their response, something like 98% of the cities with 50,000 to 500,000 people are expecting budget shortfalls. And in many cases, these budget shortfalls are in the tens of millions or even 100 million in terms of scale. So we're talking about big issues, and this will be a bit of a lag in terms of its impact on the rest of us. But for those of us who advise local governments and advise on projects that are related to public-private transactions and whatnot, this has got to have an impact. So as we think about successful outcomes or sort of various outcomes, it's a work in progress. McKinsey did a really interesting thought piece looking at the shape of a variety of different recovery scenarios. The idea, of course, is that there could be a V concept, which is probably exemplified by A3, or there could be an L, which would be the worst case scenario, basically a downward demand shift that we see on quadrant C1. Perhaps the most likely approach perhaps would be something along the lines of B2, perhaps B3, or somewhere in the B section. And the real question is, do we get back to where we were, or are we basically going to suffer a structural reduction? In China, we've seen, obviously it's a command and control economy, but we've seen a very dramatic drop followed by a very dramatic increase. That said, it's not entirely clear that they're out of the woods yet, because they're obviously linked to the US economy, and it's a global network. And to the extent that the rest of us are still struggling with our consumer spending, that's going to hold China back. So it's it remains to be seen sort of what happens with the Chinese growth curve. So we've talked about federal level, state level, local government level, and now individual behavior is really the last piece of a determinant of where we go from here. And so this is a great example of big data. This is a resource that we encountered that is updated twice a day in real time. And here you can see the reduction in vehicle miles traveled by county in the US. And it is notable that in some of the areas where we do see some hotspots currently, there has been a lack of reduction in travel behavior. Now, is that indicative of other behaviors? Perhaps there may be other factors involved, but I think it might be an indicator. And as you look at the next map, you can see in the yellow, these are the current hotspots since May 11th. And you can see that some of the heretofore untouched areas are really coming into the limelight as new areas of virus infection. So we think about sort of our behavior here, and then is that translating? Again, we will know more in the next 2 weeks, but it sets up some interesting possibilities. So with that, I'm going to kick it over to Jason and take you through his discussion of the new abnormal.
Thank you very much. So what I want to think about here is if we fast forward to say a year from now, maybe a year and a half, when things may have normalized to some degree, we may have a vaccine or a better testing protocol or whatever the circumstance, we're all feeling a little more comfortable, maybe not more comfortable, at least we've normalized our activity in reaction to this. How is that, what does the economy look like? How have we changed our behaviors, and what is the so-called new abnormal at that point in time? And that has significant economic implications. I think we can start by saying that, you know, any major event like this, whether it's the Great Depression or World War II, obviously can affect entire generations' behavior and perceptions going forward. And I'm not comparing this to the Great Depression or World War II, but there are certainly people out there who have had traumatic experiences, loved ones have died, or you maybe even just missed your graduation, or maybe you were really sick, or you just lost your job. So this is a big event. I say maybe more akin to the great financial crisis, but still a very big event that may have profound effects on the way we work and our consumer preferences and view of privacy and security and all those factors. And so I want to go through what we see kind of the highlights of these kind of potential effects, which are psychological, that may be prolonged and affect the way we move forward. You can go to the next slide, David. So I think the first and foremost, and I think this is the one that is less of a guess and is a for sure certain outcome, is that we really are having a moment with regard to technology and services. It's a beta test in some ways. This whole video conferencing things, those who were reluctant to adapt it are now for sure adapting it. The working remotely, the idea of on-demand, social interaction, entertainment, whether e-commerce and Amazon.Prime, these have all seen a major uptick. But there have been some bumps. Obviously, home networks aren't always working the way they should. And some people are really itching to get back out there. So it's still a work in progress, but for sure the technological side and even the services side, this is going to be an inflection point for that. And I would expect to see a much higher adaptation. Then the question is, how does that affect, for example, our demand for workspace? And I think there are really two different ways of looking at this. One is these new technologies really increase our ability to work remotely, and we enjoy it and we do it more. And the other hand, of course, is I think epitomized by that quote there from Robert Oppenheimer, which is the best way to send information is to wrap it up in a person. And I think that just typifies the fact that people need to be working in teams and collaborating and mentoring. And they not only, the humans need that, they want that. And so I think there will be a bounce back. The whole reemergence of the central business districts and downtown knowledge workers, this is kind of built on that need for collaboration and synergy. And the question is, these are two tensions, and I'm not sure which way we're going to go on that, but obviously there's going to be some compromise in there on individual behavior. You can move down to the next slide. Then there's the issue of not where people work, where people might want to live. Especially when you dovetail this with the life cycle of millennials, who are the big demographic out there that are making all the decisions. They may be in family formation mode right now, and so they may be thinking more about moving to more kind of less dense environments. So what's the future for the urban core versus suburbs or exurbs? Is there, there's an interesting quote here from Rob Emanuel about how things are moving to be more local. Rob Emanuel is also the same one who told us never let a serious crisis go to waste. So interesting foresight there. But it is an interesting whether regions will now become a more important role in the way in which we respond to events like this rather than national level. You can go to the next slide. Another big trend, of course, I think, is this digital divide that we all experience, especially people who don't have access to the internet, who can't join Zoom meetings, or who just their very job doesn't allow them to do this. I mean, I think I feel very fortunate that I can do this, and it's actually part of my job to do this. But if you are working in a sector that doesn't allow that, you're in a much different position, or you don't have the ability to study from home or do that. I think this digital divide is really becoming accentuated, is being more pronounced by this event, and it's a shame that it took a pandemic for this to happen, but it is something that we're going to have to address going forward. You can go to the next slide. In terms of exacerbating the economic divide, I think that's another thing that this event has the potential to do, which is, as David mentioned before, 40% of Americans really live paycheck to paycheck. And if you even look on the small business side, it's a very high percentage of small businesses do not have cash reserves. So the small businesses, many of them won't survive this. And I've heard, estimates from restaurants, for example, that it's over half or something. So that's a really big potential. Then on the other hand, you have, a lot of cash-rich investors who have the potential to jump in and take advantage of distressed businesses or assets and increase their market share. So there's this potential for a further consolidation, if you will, and kind of winner-take-all situation to emerge from this, as some people have to give up their house or their business, and others purchase and make money in the process. So this economic divide, I think, is something we already are dealing with this, and it might get worse. And I think we need to. This potentially has the effect to exacerbate this problem. You can go to the next slide. Again, this is another trend that was already occurring, which is some called deglobalization. And even before this, there was a lot of, Brexit and the trade wars in this country were really having effect economically. And this is certainly not going to make people want more trade in the short term for sure. You know, it will change perceptions of travel. I think even individual businesses have seen the supply shocks and how that affects them, and they may decide that they need to return to locally sourced providers. So this whole notion of reshoring may return, and you might, in the long term, that could be good for the U.S. economy, but in the short term, that's obviously going to have some impact. But it is a concern. It is an issue that will have major economic implications. The whole reshoring concept would be a good thing, and the reduced trade will be definitely a short-term impact. I think that from a policy perspective, we'll go to that slide in a second. There's been a lot of shock about the fact that you can go back. Well, this is fine. I'll get to it in a second. There's been a lot of talk about how we don't even make ventilators, or we don't have these basic supplies that we need. And I think maybe further impetus to say we need to start making more stuff here. You can go to the next slide. The experiential economy is a term that's gained a lot of traction lately, but it really refers to the types of things that we do that are really involve large aggregations of people, often involve travel, they involve recreation, it's lifestyle, it's entertainment, it's sports, it's going to concerts, and etc. And a lot of kind of economists have viewed that as kind of the higher end of the economy, where we started out here in the industrial age looking at abstract commodities, then we make goods, and then we deliver services, and now we're into experiences. Interesting, millennials have, if you look at their spending patterns, it's a much higher percentage of their money is spent on experiences, whether it's going to concerts or getting spas or whatever it is. It's a big part of their life. This obviously cuts to the heart of that economy, because you can't even, no one's going to go to a concert anytime soon. Sporting events are taking a whole new turn, and this economy, this portion of the economy has a lot of economic multipliers on retail, on dining, and so it's a major part of our economy. And if this retracts, and for how long it retracts, where is that new money? Where's that money that we make going to go? Where's the pent-up demand going to go? And that's a question that yet to be resolved. But I certainly, you're going to see a certain different changes in the way this experiential economy evolves. You can go to the next slide. And I think David alluded to this too. That is a defining moment for politics and for public policy. There is, if we do pull out of this, there's a sense of shared responsibility. There's a sense of heightened awareness of economic and environmental issues. Obviously, it's going to have an impact on the election. We don't know what, but it will. It's going to be a front and center issue. So how the government responds to that will be interesting. I think we go back to Rob Manuel's quote about potentially more regionalism, where we leave decisions more to regional, to state and local governments, because we feel more confident at that level. That could be one potential way in which the pendulum swings if we do not have significant confidence in the way that our federal government has dealing with something. So this, I think, again, has economic implications on the way in which we, on taxation and economic policy. You can go to the next slide. The next slide is really kind of jumping off of this point, which is really more of a discussion issue, and I think we can maybe Sheila and Jim can enter in here, but it really talks about the fact. I mean, we're all, even Republicans and Democrats are all in on basically making sure the economy stimulates investment, making sure the economy comes back. But the question is, what do we do with that money? I mean, is it up till now, it's been really focused on shoring up households and businesses so that they can limp through this crisis over the next couple of months. But longer term, if we do that, I mean, there is an opportunity for using that stimulus to invest in overlapping threats. Whether it's looking at, safety net issues, healthcare or universal income, which was a big issue for a while, or whether it's investing in retraining or broadband, so that this digital divide thing can be addressed, or other issues, adaptation and resiliency to future natural disasters or pandemics. It's a moment. So I'm interested in, before we go to the last section of this slide, I'm interested in hearing from others about how this full circle on the public policy side of this.
I'll be happy to chime in on that. This is Jim. I think a lot depends on what happens with this reopening. If we kind of go through that rather smoothly and we don't have a major recurrence of infections and deaths, I think we'll find a much easier transition to, something that looks more like normal. If there's a vaccine developed and some therapeutic treatments, that would also help. But if we don't have those things, and we have another recurrence, it could be a really big setback. And I think, as Jason mentioned earlier, there's so much of this is psychology and how people think about risk and think about socialization and socializing and things like that. And some of the things that are going to affect, particularly this experiential economy, people's confidence in travel and going into places where people congregate, how fast that comes back, or if it's really different and in the future, I think it's going to have major implications on what kind of recovery we have. And I think the work at home thing, I think there's no doubt that we're going to see a huge increase in that has long run implications. People have gotten used to it. The tools have gotten better. Major corporations like Twitter and Facebook have basically said, go ahead and just work from home either permanently or at least for the end of the year. So, what does that mean for supporting local restaurants and businesses in downtowns and things of that nature, and how people decide where to live versus where to work and those kinds of things. So a lot of different elements to this, and a big part of it does really depend on whether we wind up with another wave of this, I think.
I think the other part of what Jim touched on is consumer confidence and what people think about the economy. With so many people being employed in, particularly here in Arizona, the travel industry, restaurants, those kinds of jobs where you cannot stay at home and do them. There is no option. And if Jason's, information about half the restaurants don't open, I've heard 40%, maybe not quite as bad as half, but it's definitely significant. If we have huge sectors of the economy where people have no option for staying home and performing a job, then I think we're going to have some real challenges, because we've got some mitigation things that are in place now to help with rent and help stimulate the economy on an individual basis. But if we have so many people who have no income or very low income, they're not going to be able to stay where they're living. We're going to have all kinds of challenges in the rental and housing market. So my concern is consumer confidence, and at all levels of the economy.
And Jason, we've talked in the past about the over-retailing of America. And if you look at the numbers, we have something like 20 to 25 square feet per capita in the US. And you compare that to Europe, and you're well under 10 square feet per capita in Europe. And a lot of our retail space, as we all know, has been is located in secondary or tertiary locations that perhaps were more viable, a decade or two ago. There's a lot of retail that is, frankly, just barely hanging on prior to the pandemic, that has been sort of exposed by the pandemic. And so some of these underlying weaknesses, I think we can expect to see some, corrections, most certainly. And so I think where we see those maybe surplus retail spaces or sort of susceptible retail spaces, it's very often in the form of corridors and obsolete malls and other properties. And so I think that's an interesting sort of it's a juncture, and it's an opportunity in a sense to reposition a lot of properties more effectively for the economy that's coming. And that might, include some new mixes and new patterns of development along the lines of what you've been suggesting. But Jim?
We did receive a question so far. There were two questions that have come up. One is, will we make the slides available? And the answer to that is yes. And also this session's being recorded, so you'll be able to get the whole session, but happy to provide this slide deck as well. But the question that was posed was, what are the characteristics of some of the cities that actually have a chance of recovering more quickly? And probably, there's there's so many different dimensions to this, but certainly the ones that are, or at least segments of the economy that are huge economic drivers that don't require face-to-face work, as Sheila was describing a lot of these restaurant and service jobs and things like that, the cores of their economies might return more quickly. It's interesting that where you're seeing the openings now and where you're seeing people really coming out of their homes are in entertainment locations. But there again, it's a question of what's going to be the implications of that. Is that going to cause, you know, another recurrence of this and then a real pullback from that? Obviously, there are some places in the country that have been less hard hit or took earlier actions. You know, the Bay Area has been pretty fortunate that we had our stay in place came early. And, you know, hopefully that means that we have a chance of recovering earlier too, as what some other cities that took actions, you know, fairly early in the crisis. Have anybody else had any thoughts on that?
Yeah, I think it's an interesting, kind of goes back to the very beginning of this, versus the notion of public health versus the economy, a kind of a false dichotomy. I think we will all agree. But the issue, for example, California, we are much worse. We're 20% unemployment. I think and we of course also have a very favorable. We've done very well in curtailing the spread of the disease. So we're really positive on the public health side, but the economic side, we're kind of on the other end of the spectrum. Part of that's because we're such a tourism-based economy. It's not necessarily because we've gone too far in protecting public health, but there is a interesting a question there about what cities will recover faster. I think there was a study on this very issue, the Spanish flu, and it did show that the cities that were actually had the least impact were the ones that recovered the fastest. So protecting public health, in fact, in that case at least, was a big indicator in terms of the pace of the rebound. So I do think that while there is short-term pain associated with keeping things closed, the worst thing you might want to happen is a resurgence where you think you're out of the woods and then you come back. And if you want to have an impact on psychology that's negative, that's a big one, because you get stung twice. It really affects your behavior going forward.
I would just add to that the challenge of social inequities. As everybody probably knows, the Navajo Nation, which is primarily here in Arizona, but is in 2 other states, has had the highest incident per capita of COVID-19. Part of that has been the fact that approximately 30 to 40% of the homes on the Navajo Nation do not have running water. The Navajo Nation is the size of the state of West Virginia. It's huge. And I believe last I heard there were 5 ambulances for the Navajo Nation. So there is a huge amount of lack of infrastructure in some of our harder hit communities. Some of those are defined by places, by race, by economics, by other social indicators. And so I think we will maybe see an uneven return, because some communities are so far behind to begin with. And when you add the epidemic on top of that, they really have a lot to deal with: lack of internet, lack of healthcare facilities, lack of general infrastructure. So I think we're going to see a lot more of this disparity come to light in some of our communities.
That's a really good point, Sheila. I think that the other demographic is the young. So for kids coming out of school right now, I can't imagine a more challenging time with mounting student debt and, dependence on retail to get them, through the divide and to their permanent job. And then you look at all the flux that's in place in their larger career goals, and where is the economy going? So it must be a very challenging time to be coming out of school and moving on with your life.
Well, also too, the people in the age 40 bracket, they got hit with the 08 recession, and now they're getting hit with this, and really are reeling from, I'm never even going to make what my parents made.
That's right. That's right. Yeah. And the virus is uneven in terms of its incidence, in terms of male, female. So in I think it's the 35 to 44 age group, basically it's taking 5 male lives for every 2 female lives. So that's going to have long-term effects on the economy. So we're going to see, you know, in terms of thinking about a dependence ratio, you know, the number of day-to-day workers as a percentage of the total population, including the very young and the very old that aren't in the labor force. You know, thinking about our ability to carry these populations on the backs of a smaller kind of residual labor force is also a challenge. But it's all a balancing act, and I think that it's interesting. Yesterday's New York Times front page has a headline: California in rush to save lives, pushed potent economy to brink. And so that's a narrative that's starting to come around the other side and say, well, maybe California was too cautious. That's, you know, at least what I'm reading between the lines there. But that's a really tough call. What is that optimal kind of position between economic viability and public health responsibility? And it distills down to a very cold and calculating discussion at some point, which we all want to avoid. But at the end of the day, we have to determine sort of where is that sort of optimal point between economic and public health interests, and there is no easy answer.
We have another question here. I don't know how much time you have for discussion, but someone asked for us to talk a little bit more about the impacts on transit-oriented development, and how developers are looking at that in terms of density and mixed use, and how consumers and tenants also are looking at it. And I would just say one thing on that real quickly, and this is in the midst of the the shutdown, but the traffic on the Bay Bridge going into San Francisco is only down about 16%, and BART ridership is down 96%. So people are very fearful about getting on public transit. It's just, we know, we've been at capacity for BART for a long time, so people are really packed in there, and it's always been a bit of a petri dish, but now people are just trying to avoid it. So is that a permanent trend? I don't know.
I've read actually places like where I'm from here in Phoenix, we're going to recover faster. It's going to be one of those factors where we recover faster because we have such a poor public transit system that people are able to get to jobs without it, and they don't face the fears that you've just outlined.
And it's a theme that runs throughout this is the punctuation of trends that were in place prior to the pandemic. And in this case, we were seeing the emergence of the last mile solution in the form of e-bikes and e-scooters, basically making a huge dent in the ridership of transit agencies. And so that already was becoming an issue that was sort of getting the agency's attention, and now it's even more involved and difficult to deal with. So I think we have to think long and hard about the future of TOD. We don't think it's going away anytime soon necessarily, but perhaps there are shifts on the margin, and perhaps there are shifts to more exurban communities that still have elements of transit-oriented and elements of urban life, but in a less dense configuration. These are all great questions and issues, and actually these are things that we're going to be coming back to and talking about in considerable depth next week. So it's a great question, and we want to tease up as many of these sort of end of the day questions regarding asset classes and land uses as possible, because that's what we're all doing in our daily lives, and we want to know sort of what are the practical implications. So I think that sort of leads into Jim, sort of where we're going with our industry analysis and sort of our evaluation of cross-cutting real estate impacts as we go forward.
Okay, well, we're just getting ready to wrap up here, folks, but this is really just a little bit of a teaser or a preview of what we'll talk about in our next session. And obviously, this has major implications for all kinds of real estate and other assets. And what this chart is just showing you how the year-to-date performance has impacted various sectors. Industrials are the least. The stock market is amazingly and surprisingly continuing to be very strong, which hopefully is an indication of long-term confidence and not just the Fed policy and things of that nature. And at the bottom of this is the hotel and retail experiential kinds of businesses have really just gotten hammered heavily. And that has a lot of knock-on effects for other sectors as well that we'll talk about more. Construction is starting to kick back up again. I think some plans have been kind of set aside to be reconsidered, maybe reformed in some fashion as people start to look at this. And one of several of the clients that have hired us are big tech companies that are trying to figure out what they're going to do with their real estate footprint and how they want to address the workplace. So the jury's still out on that, but it could have really significant implications.
And it's all on the table. It's all on the table in terms of whether existing concentrations of tech would stay in places like California and Washington, or are people going to be following the lead of others and looking at other markets throughout the U.S. And this all has to do with the preferences of the labor force. And do people see a need to go to an office? And so there's a real consideration now. For example, Facebook recently announcing a serious look at working from home permanently for a good proportion of their employees. And I think Google has stopped construction across the country. So we are in the midst of some serious decision making that's happening in real time. And we're fortunate to be in the middle of this as a company, but it is a window into some clear sort of degrees of freedom in terms of where we're going as a society, and how we use office space, and what mixed use development even means going forward. So we're going to explore that in a lot of detail next week. It should be a great discussion. So Jim, sorry to interrupt.
I just described this. This is a graphic that is actually in progress, and the size and direction of the arrows indicate what we think the likely impacts are from a short-term and structural point of view. And I think we'll be honing this down in the next interlude here between this session and the next session. And particularly as it relates to the use of office space, I think we're showing now that it's a relatively short-term impact, and maybe neutral impact over time. And some of the adaptations around that just could be moving away from this open floor plan workspace type of thing to more individual offices or more protectable space or what have you. We don't think the need for social and face-to-face interaction is going to disappear, and we're all getting a little Zoom fatigued, I think, at this point already. But that's something we're looking very hard at. We do think the hospitality industry is going to take a while to come back. I think people are just going to be leery about getting on airplanes and traveling and congregating in the kind of groups that they have. But, I hope that's not the case for too long, because I want to do some more traveling. Warehouse industrial, we're going to see, even more probably of this home delivery type of goods distribution that's already very dominant in our society. So I don't know how much farther that can go. It's pretty extensive already. In any case, we'll be honing these things down over the next period of time, and be diving into them in more detail in the next session. Sheila, you want to wrap this up, or I'm sorry.
Yeah, quick, Jason, I don't know if you want to hit this one.
Well, yeah, I mean, I think that we talked about impacts by sector. I think they're also going to vary by location, and we've talked a lot about that, and about downtowns and what was going to be the impact in some downtowns, which were experiencing a major renaissance over the last 10, 15 years. Is that going to retract? One of the big drivers of the downtown retail sector has been office workers who are there eating lunch. That's what is replaced downtown's old role as being a place where people would buy major important goods and services. That doesn't happen in downtowns anymore. It's more of an entertainment district. And so whether or not a downtown can rebound is a big question. The idea of adaptive reuse of some of these malls, dying malls in particular, that was already a trend that's going, and this may be a death knell. So that is a mixed bag. There may be an opportunity on that side. And a lot of places like California have major housing shortages and whatnot. That may be an opportunity for reusing it, or even for tech campuses. And that's happening already. Google has taken over a mall in LA for the tech campus. And then the question about suburban environments, again, they may have will the millennial life cycle make the suburbs a new, more attractive option, particularly if their relative pricing is lower currently. Maybe it's like, you know, my own backyard, it's time to raise a family and the suburbs are looking good again. So these are all open questions, but we want to delve into this in the next section.
Well, thank you. I want to send really sincere thanks to Jim and your team, David and Jason. You've given us many, many things to think about. Here is our next session, June 3rd. It's the same time wherever you are that's on this call. We're trying to keep things consistent to make it easy for people to be able to participate. And on behalf of LAI International, thank you very much. Thank you to our panelists, and thank you to all of you that attended. We look forward to seeing you next week. Thank you.